We have a quick question here from Sukrash, who asks why the US dollar Japanese yen is correlated with the US 10-year bond yields. So thanks for the question, Sukrash. So to answer the question, the very first thing that I would like to note is that the correlation between the USD yen and the US 10-year is just like any other correlation. And that means that it's fluid, which basically means that the strength of the correlation and the importance of that will change from time to time based on the different economic circumstances that you're in. And if you take a look at the charts, if you just overlay like we did here with the US 10-year in orange and the USD yen in blue, you can see that even though it is correlated, there are times when you can actually see these two moving in opposite directions with each other. So it's not a perfect correlation. Like any correlation out there, it's not perfect. And also keep in mind that just because something is correlated doesn't mean that the one necessarily causes the other one to move. So sometimes they do, but it can also be due to other external factors that might be affecting the US 10-year or the USD yen simultaneously, whether it's the same factor or not. So just do keep that in mind. Now, the correlation between the USD yen and the USD 10-year mostly just comes down to the interest rate differential between the US and Japan. So, or the interest rate differential or the bond yield spread between the US 10-year and the Japanese 10-year, or otherwise known, like we said, as the bond spread. So it's not just because of the US 10-year, it's actually looking at the spread between the two yields. Now, it's important at this stage to remember that in Japan, interest rates are currently negative at negative 0.1%. And apart from that, the BOJ also has yield curve control, which aims to keep the yields very low. So we have interest rates, short-term interest rates targeted at negative 0.1%. And then we have the 10-year government bond yields that's targeted at around 0%. So in other words, because rates and yields are expected to go nowhere anytime soon in Japan, you only need to really look at the US 10-year to see where the actual rate differential between the two are going. So with Japanese rates in negative territory and yields not going to rise anytime soon, a key factor to keep in mind for the USD yen and the USD 10-year is, of course, carry attractiveness. So if there are expectations that bond yields in the US are going to rise, and those expectations are based on expectations to see economic growth and expectations to see inflation rising, that means that it's not based, the expectations for higher rates are not based on the Fed that's going to raise rates anytime soon. It's based on the view of the economy recovering and based on where the future Fed policy is eventually headed. Now, when that happens, the market thinks that US rates are moving higher or expected to move higher, then there is a growing carry advantage to use the Japanese yen as a funding currency and basically buy something like the US dollar against that. Now, once again, the reason why the yen is attractive as a funding currency is because the interest rates are negative, and more importantly, the BOJ keeps the Japanese bond yields low with yield curve control. So when the market thinks that the worst is behind us, so like we saw with the US bond yields a couple of days ago, let me just quickly go to the H1 here. So when the market thinks that the worst is behind us and economic growth is what we're going to get, then you're automatically going to see the market starting to price in higher, longer dated yields, right? So when the market thinks that's going to happen and the worst is behind us, they will look to sell their safer havens like treasuries. And that, of course, causes the bond yields like we've seen to rise. And when that happens, the US dollar becomes more attractive than the Japanese yen, since rates in Japan aren't expected to go anywhere anytime soon. Now, there is a caveat to keep in mind. When you look at this correlation, it is important, like we mentioned, to keep the current market climate and the circumstances in mind. So as you know, the dollar is always considered as a safe haven as well, especially during times of immense market uncertainty. But that safe haven appeal will change from time to time, depending on where we are in terms of the overall economic climate. So as an investor that needs to, let's say, rotate into safer havens, would you rather do so in a currency or with bonds that gives you a higher yield or a lower yield? Obviously, the answer is a higher yield, especially if you're talking about the other currency being the reserve currency of the world. So my point of this is that even though the correlation is important, even though it's based on yields, there can sometimes be some safe haven inflows that might complicate it. And that's why we said at the beginning, it's very important to always keep in mind that correlations can and they will change in terms of strength or importance based on where we are in the economic cycle, based on economic circumstances, and of course, changes in the overall interest rate regime. So hope that helps with the question, Sucros. As always, any others, please don't hesitate to let us know.